Good morning and welcome to Charting the Markets on Friday, the 2nd of February 2024. Yesterday, the Bank of England left its interest rates unchanged at 5.25%, but interestingly enough, we had one of the MPC members voting for a rate cut, and this is the first time in years we've seen that. We still have, obviously, two who wanted to have a rate hike, the Hawks, and those used to be three, but now that's still two left, and then we've got six who voted for hold. But the Bank of England is expecting the inflation rate in the United Kingdom to slip back down towards its 2% target by the second quarter, so much earlier than expectations which previously were for next year for that target to be hit. And the Bank of England looks at private sector wage growth, services inflation, and wage growth in general with regards to making its decisions concerning interest rates in the United Kingdom. So we'll have to watch those pretty closely in the next few days and weeks. But all of these are expected to ease. Now, in the United States, we had the Fed out on Wednesday, where the US Federal Reserve also kept rates unchanged. And basically, we had Treasury yields fall quite sharply on the back of that as rate cut expectations were changed. And basically, that led to a weaker US dollar over the last couple of days or so. Also weakened by the renewed regional banking fears as New York Community Bank worried about bad loans, and as its share price dropped quite drastically by about 40% at one stage, and the whole index, the regional banking index in the US, falling by about 12%. Now, that was then offset later on by after-hour earnings by the likes of Amazon, which reported sales up by about 14%, higher than analysts had expected, and that led to a rise in the Amazon share price by about 10%. We had Apple down slightly about 3% on weak China sales of iPhones. But we also had Meta platforms basically having its revenue beat expectations, and that together with the announcements of its first dividend payment and a $50 billion share buyback boosted its share price, which led to a rise of about 17%. And all of that pushed the Nasdaq 100 back towards its record highs. And let's see whether this had an impact on the FTSE 100 overnight. And we can see here that earlier this morning on the Daily Financial Bet, we did try to rise back up again towards Wednesday's high, which was made at 7,690, but didn't quite manage to do so before slipping back again ahead of this afternoon's non-farm payrolls out at 1:30 p.m. in the US, which will be very closely monitored, because the payrolls and the employment rate in the US is declining, has been declining for several months now, and we'll have to see whether we will see weaker payrolls than expected. And if we do, it may lead to an investor thinking that perhaps the Fed will actually cut rates sooner than now expected, because at the moment we're pricing in about a 65% probability of a May rate cut. And at the end of last year, we had the same probability for a March rate cut. But after this week's Fed meeting, that is no longer on the table. But with regards to the FTSE 100, if you look at the charts, then you can clearly see that as long as we stay above the last reaction low, that is to say a low on the daily candlestick chart, which is lower than the one to its left and to its right, and that was made yesterday on Thursday at 7,600. As long as we stay above there, the trend is your friend, and that's still pointing higher. So we should continue to rise perhaps next week. Obviously, depending on today's non-farm payrolls. But if we were to take out the high at 7,690, we would be heading back up again towards the mid-October high at 7,702. And then above there, we've got the highs going back to July and also September of last year between 7,723 and 47 as potential upside targets for the FTSE 100, provided we stay above Thursday's low at 7,600. Moving on to Germany, we can see here that the German stock index slid together with the US indices as the Fed kept its rates unchanged, but then recovered on those very strong earnings we saw yesterday out of the US and led us to make a new record high on the DAX 40 index, the German stock index. And here you can see on the daily financial bet, we rallied all the way to 17,020, which is a level we are aiming for today ahead of non-farm payrolls. But I wouldn't be surprised if not much upside or also downside were to be seen ahead of non-farm payrolls, because everybody's going to watch those very closely, and also average hourly earnings to see whether the Fed might be forced to act sooner when it regards cutting rates in May of this year. So if we were to rise above 17,020, above there we have no man's land really, but the next upside target would be probably around 17,100, with a view of perhaps over the next few weeks and months, if risk on sentiment remains in play, perhaps the 17,500 area being targeted. Now, again, here from a technical perspective, upside pressure will remain in play as long as we stay above Thursday's low, yesterday's low at 16,782 on a daily chart closing basis. Now, talking of the US, you can see here the S&P 500, which on Wednesday, on the back of that Fed meeting and the Fed keeping its rates where they are at the moment, sliding slightly, and we fell back down to 4,842. But from there, we rallied all the way back on these strong tech earnings we saw yesterday out of the US, made a new record high at 4,941, and are still heading towards my upside target, which I've had in place since the end of last year at 5,000, simply because it's a round number. It acts as a magnet for the S&P 500, in my opinion, and we should be heading towards that high at 5,000, provided we stay above this week's low at 4,842 on a daily chart closing basis. The US dollar has weakened over the last few days as the Fed kept its rates unchanged, and therefore yields in the US slid quite significantly, and also on the back of worries to do with the regional banking crisis in the US rearing its heads once more. That, together with weaker employment data over the course of this week, ahead of this afternoon's, I should say, non-farm payrolls at 1:30 p.m., has led to a weaker US dollar, and the euro has benefited from that. As you can see here, the euro dollar financial bet has risen above the December to February downtrend line here. We broke through it earlier this morning, and it is currently acting as support around 108.66. And it looks to me as if we are heading towards the orange line here, the 55-day simple moving average at 109.15, and also last week's high at 109.32. Now, if non-farm payrolls were to lead to a further slide in the US dollar, we could see the euro US dollar exchange rate head back up again towards its November and also mid-December highs between 110.09 and 110.17, provided we stay above our last reaction low, that is to say yesterday's low at 107.80. Another currency pair which looks interesting is the British pound against the US dollar, and as you can see here, we've also bounced off our 2.5-week low at 126.26 yesterday and rallied to last week's high around 127.75. But it together, as you can see here, with the highs going back to November and mid-December of this year between 127.33 and 17.94, acts as a pretty good resistance area, together also with the mid-January high at 127.86. So we've got pretty good resistance at the moment between 127.75 and 94, and above there sits the December peak at 128.28, which also represents another upside target, but could, together with these other previous daily highs, act as a strong resistance area for the currency pair. And as you can see here, we've basically just bounced off the lower range of our sideways trading range we've been in since the end of December, and are now heading back up again towards the upper sideways trading range. and we'll have to see whether we can manage this time around to break through it to the upside, in which case we should be heading towards the psychological 130 mark. Now, the euro against the US dollar is also looking quite interesting because it slipped to a 5-month low on those interest rate cut expectations between the European Central Bank and the Bank of England. And you can see that in the course of this week, we have managed to stay and hover above the 85.14 low. As I said, a 5-month low. If I go back to the chart, you can see the last time we traded there was in August of last year. And basically, the trend is your friend, and they're still pointing lower. As you can see here, we're still trading within this sideways, within this downward trending channel. And therefore, the odds are higher for us to slip through 85.14 than for a bullish reversal to be seen. And if we were to fall through 85.14, we would head towards the July and August lows of last year between 85.04 and 84.93. So that's the next big downside target zone that we could be aiming for, provided we stay below not just the last reaction high from Thursday, but the one from Tuesday of this week at 85.67. Now, why am I using this one and not the previous one as I usually do? The reason for that is it's very close to the previous one, so we might as well have a slightly wider stop if we're short, because it is only a few ticks in this case, a few pips, I think 7 pips difference. And that high, as I said, on Tuesday came in at 85.67. Provided we stay below that, the downtrend is still intact and should continue to take us to lower levels. The weaker US dollar has helped some commodities to rise, but before we look at that, we can also see that the oil price this week is actually heading towards a 1-week low, and it has declined quite significantly. I mean, if you look here at the price of WTI, these are the front-month futures contracts, but you can see here that we have not only fallen through the January to February uptrend line, but we are now also trading back below the 200-day simple moving average and have slid from Monday's high, which happened on the back of a US base in Jordan being hit by a drone by Iran-backed militias and killing US servicemen in the process. That has led to the oil price gapping higher, the futures contract on Monday morning. But since then, the worries to do with China, the world's largest importer of oil, and its economy and perhaps future demand being lower than it is what it was forecast previously, has led to a sharp decline of nearly 6% in the price of crude oil. And you can see here WTI yesterday hit the orange line, the 55-day simply moving average here at 73.74, which incidentally has again acted as support today. Now, if we were to fall through today's low at 73.64, the next downside target really is the mid-November low at 72.38, ahead of this key support area, taking us back down again towards the December and January lows between 70.61 and 67.94. But as I say, 72.38 would be the next downside target for the oil price, which has been sliding in the course of this week. And for that bearish momentum to stop, basically from a technical perspective, what we would need to see is a rise above the late December high at 76.20, and also ideally above the 200-day simple moving average at 77.27, but that looks pretty unlikely at the moment. Now, if we look at wheat prices, these have benefited from a slightly weaker US dollar. As you can see here, we have risen once again. And interestingly enough, in the course of last week, we broke through last week the downtrend channel we've been trading in since the end of December. And then we basically came back down and retested the upper downtrend channel line. And that quite often happens also with resistance lines or downtrends. If they get broken, quite often we have a retest of that trend, and then we have the move to the upside. So at the moment that hasn't happened as yet, but we have risen above the orange line here, the 55-day simply moving average at 607.65, and as long as we stay above this week's low at 592.1, we should be heading back up again towards the red line here, the 200-day simple moving average, and also last week's high at 623.30 to 625.97 on US Chicago wheat futures contract prices. And last but not least, I'd also like to mention soybeans, because soybeans had a really, really good trend. It was one of our trading the trend sells back in December, I believe, for last year, and has worked out really, really well. And you can see here we dropped down to 1,195 on the front month futures contract. And I have to go out onto a weekly chart to show you that that was very close to the May 2023 low at 1,190. And just below there, we've also got the November of 2021 low at 1,185. So it's a big, big, big support area coming in between 1,195 and 85. And you can see that we're heading back down towards that as we failed to bounce any higher on Wednesday of this week. We rallied to 1,229, but then came off again. And basically, as long as we stay below that high, the last reaction high, which is higher than the one to its left and to its right on the daily candlestick charts, the downtrend is very much intact, and the odds are favoring a retest of that key 1,195 to 85 support area. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG, and I wish you a lovely weekend.